The Federal Reserve is expected to cut borrowing costs when it meets on Wednesday. So what does this potential rate cut mean for millennials and Gen Zers out there? Joining us now with more on what we can expect is Vivian Tu, money influencer, CEO and founder of Your Rich BFF Media. Welcome.
Thanks so much for having me.
Now, what has sparked the Fed's rationale for cutting rates?
Yeah, so the Fed has two major mandates. One, make sure pricing and inflation is stable, and two, making sure employment is high as humanly possible. We saw them raise rates post-COVID due to runaway inflation up to 9%, but now that inflation's come back down to earth, they're starting to think about their other mandate, and they're saying, hey, we want to lower rates so people are going to borrow more money, do more shopping, buy more stuff, and essentially create more jobs. And we're going to see economic growth from that.
And, you know, for millennials and Gen Zers looking to buy a home, how do you think this rate cut will impact them?
So clear cut, the Fed funds rate, which is the rate that the Federal Reserve determines, impacts all other rates. So mortgage rates, car loans, personal loans, everything like that. As the Fed funds rate comes down, we'll naturally see mortgage rates come down as well. That said, I don't have a crystal ball, and it doesn't necessarily mean housing prices are going to come down. It just means that borrowing against a mortgage for a mortgage is actually going to be cheaper.
Now, if you can't afford a down payment, should you invest that money instead?
It depends on your time horizon. If you're going to need that money within the next 10 years, I would say maybe invest in something a little bit more low risk, low return, like a certificate of deposit. But if you have longer than a 10-year time horizon, investing in the stock market probably makes more sense.
And how can young people, build savings to afford a down payment?
Yeah, we talk so much in our society and our culture about scrimping and scrounging and avoiding the avocado toast, but I really like to emphasize on the other half of the equation, which is you can only save as much as you earn, but you can always earn more money. So I really encourage folks to make sure that they're asking for a 10 to 15% raise every single year, to be leaving their jobs every 3 to 5 so that they can get a meaningful pay jump, and also picking up side hustles.
And for young people with high credit card debt, what's the best way they can take advantage of lower interest rates to get that balance down?
Yeah, definitely. One of my favorite strategies is using a personal loan. So you can go to your local bank or your credit union and essentially request a personal loan, which is a lump sum, and you can use that to pay down any sort of credit card debt balances that you have. In the meantime, you would then cut the credit cards or put them somewhere very safe where you won't be tempted to use them. But then you can pay back the personal loan instead of that credit card debt. And you're going to be looking at an interest rate of anywhere between 7 to 15% versus the 20 to 30 you'd likely see with a credit card.
All right, let's talk student loans. How will paying or not paying off a student loan impact your credit score?
Yeah, I think we have this large conversation about I got to get all of my student loans paid off. But what you really need to actually just do is make the minimum payment. In many cases, if you got a federal loan in the past few years, you likely have a low interest rate loan, anything between 4, 5, 6%. And so there's no real rush to pay it off. That said, if you don't make the minimum payment and if you aren't paying, on time and consistently, you will see that reported to the credit bureaus, which could negatively impact your credit score.
Now, for young people looking to consolidate their 401k, how will lower interest rates impact 401ks?
Yeah, so in 401ks, you have a bunch of investment options, everything from bonds to equities. And as we see the Fed funds rate come down, you're likely going to see general bond returns across the board also follow suit. But when it comes to the equities market, with this lower cost of borrowing, companies may be able to do more and increase corporate profits, and thus, we might actually see the stock market perform in a really healthy way. So it just is going to change the calculus of what people are investing in.
And speaking of that, for young people looking to invest, what sectors would you recommend for their first time?
Yeah, if you are a first-time investor, there are no recommended sectors. I say invest in the entire market, whether it's an index tracking ETF that tracks the total stock market or even just the S&P 500. It's a lot easier to kind of buy everything than try to cherry pick the perfect sectors or the perfect companies.
All right, Vivian Tu, money influencer, CEO and founder of Your Rich BFF Media. Thanks so much for joining us.
Thanks so much for having me.